Hi, everyone. I'm James Garbutt.
And I'm Denny Dumas.
And this is the Garbutt Dumas Real Estate Podcast.
Today's a special episode, James.
Oh, it is.
We have our good friend and business ally, mortgage broker Shaun Francis, on the podcast today. He's going to answer all of our mortgage broker financing questions today.
Thanks for having us. Or thanks for having me,
Shaun,
guys.
thank you for being here. Let's also emphasize, for those that are not watching this, Shaun is the best dressed mortgage specialist out there.
I'm blushing right now.
Yeah, and he's been a good friend of Denny and I's for quite a while. So we've done a lot of deals together, but outside of business, we're still great friends.
Shaun, you're 3 for 3 on the dress code comments, by the way.
Well, thank you.
On your
Appreciate
podcast.
that. Thank you.
Yeah. You should be having red pants, though, Shaun. It's more
I do have a pink.
Oh, you do have a pink
right
kind of?
there,
Okay,
yeah.
all right.
I like to call it salmon.
All right, where do we begin?
Why don't you start?
Yeah. Okay. So Shaun's a specialist. I mean, we get a lot of different questions from first-time homebuyers and even nowadays lately from investors about, kind of wanting to get a better understanding of, how the math works or what affordability, what, they want to buy their first home or they want to buy an investment condo and it needs to make sense. So I guess, maybe we'll just start on the kind of simplest thing, Shaun. When you're meeting with a buyer, and I imagine first-time buyers typically have more questions for you in this department, but what are some of the things that you're advising them on when it comes to prepping them for giving them a financial approval? Take us through your process.
So what I like to do for the first-time home buyers is I just want to kind of get to conversation of where they're at for their employment situation, right? A lot of people are not aware that you have to have some sort of full-time income that's consistent before you can qualify for a mortgage. I'll give you an example of someone who works casually as a nurse, hasn't done 2 years history, that takes shifts and then gets good income for 6 months. They might not necessarily qualify because they need to be able to demonstrate a guaranteed hours and or be working consistently for 2 years to qualify over a 2-year income history. Another thing that people fail to understand is those their credit scores. That Rogers parking bill, that Rogers cell phone bill, or that credit card that's been left unpaid for years before can come back to haunt them because as they're trying to get qualified for a mortgage, those are the things that lenders look to be able to see if you have the kind of credit worthiness to be trusted to get a mortgage. So the first thing we did is we got to figure out what their income situation is and if it's stable. And the next thing is to figure out if their credit is in a good enough shape to be able to get financing when they go to a bank. So if they, and just to go on this, so if they don't have that addressed, that way we can be able to prepare them to get into position to get that address down the road, for example, because if you tackle these things soon, then they can be able to get qualified months later.
So just to clarify a couple of things. So you mentioned, it's good to have a track record of working for a company for 2 years.
Correct.
Not being on probation, obviously.
Definitely
Yeah,
not being on probation, yeah. But if the end of the day, we just need to ensure what kind of employment situation they are in. So if they are casual, that is not a deal breaker, but we need to be able to have a track record of income to be able to qualify them, right? And if they're in the position of potentially getting hired or choosing a casual shift or full-time, and because they know there's an upcoming purchase, then now that they have this information in hand, they can then accept that full-time position if they were on the fence because they know that there's an upcoming home purchase in the plans, right? Or if they're family planning, for example, if you're looking at going on mat leave, for example, the way that the lenders look at their income, if you're going on mat leave, is they can take 100% of the mat leave income. But if you go into an 18-month mat leave, for example, then the income that you can use is scaled back to 65 or 70%, right? So that also then plays a factor into what they can afford for a home purchase.
And I guess just regarding the debt side of it, when people have a leased car, when they have credit card debts,
Student loans, even.
student loans.
Definitely. Those are all another thing that weighs into the qualification for a mortgage because there's a certain amount of income to debt, housing debt, car loans, all those things that can go into qualifying for a mortgage. So if you, for example, then decide to lease or buy a new car, that will impact what you can get qualified for a mortgage. Or if you decide to co-sign a loan for your brother, your sister, your parents, because they can't qualify, that could impact your ability to qualify for a mortgage because the rules are so tight now to get qualified. Every single penny of their income needs to be used to qualify for the mortgage.
Okay, so when they go through this, when you're meeting with these, when your customers or clients, and you take them through that process, then they get their budget. Whether they have to reconsolidate debts in some way or not, they have a budget that they're working with. Aside from that, is there ever a discussion where maybe they choose a maturity date of their loan 5 years from now, and say they have kids and go on maternity leave, and lose that designation of one job? Have you ever run into situations where they may not requalify for an extension of their mortgage after a 5-year window? Or
so typically, the individuals that get qualified for a mortgage and then the mortgage does its 5-year term, for example, they don't need to requalify for the mortgage when it comes for renewal, right? All they need to do is whatever institution they have the mortgage with, under the guidelines right now, if you're still in good standing, you can just renew with that lender. However, if you're looking to switch lenders because you want to take advantage of lower rates with another bank, for example, and or if you want to pull equity or refinance and get cash out, that's when the whole requalification process is necessary. So that's kind of strategy-wise. Like if you are wanting to stay with your existing lender and your income situation has gone down, or if your working situation is different, you don't have to requalify, but you do need to requalify if you're trying to make any changes outside of that lender that you were working with before.
And I imagine banks like the security of doctors and lawyers over entrepreneurs and self-employed people.
The ways the tax code has gone now is they're really pushing people to declare more income because the individuals that have a taxable income are getting qualified easier. It's not impossible, but anyone that has a T4 slip, higher T4 income slip, those people are having an easier time to qualify with the big banks. It's not impossible if you're self-employed, but you have to go to lenders that have programs specifically for people who are self-employed, and or you need to look at having a higher down payment if you're declaring less income if you're self-employed.
Let me ask you this. If you have a household family income of, say, $150,000, and that was two people that are maybe doctor and accountant versus two people that might be, a realtor and, a seasonal worker or something like that, or something part-time, but basically same income, different levels of risk, clearly. Do banks look at that differently?
So if you have $150,000 from two people that declare that on their tax returns and they pay taxes on it, they're two basically different applications. Even though the person who's a realtor generates a gross income of $150,000, but because of tax planning and write-downs, that what they pay taxes on, for example, might be $65,000 or whatnot, that individual will qualify on paper less than the person that has a T4 income, right? Okay. Even though they have the ability to technically be able to service the payments the same.
Okay.
But what if your taxable income is the identical? Just your risk maybe a little bit more being self-employed versus being a nurse or something like that.
If taxable income is the same, the way the lenders will look at it will be the same. So, regardless of your industry or whatnot, if you had the same down payment, the same income, then the way the banks look at it will be the same. That being said, you have, for example, deals where you have exceptions, for example, and then that's where those things come into play. Credit score of 800 versus a credit score of 700. You have the person who's a realtor that has the potential to have additional variable income because they have potential upside in the market. So if there's an exception for, sliding scale, because when you do a deal, a purchase price over $1 million, for example, there's a maximum percentage of the purchase price that the lender will give you. And then you have to get exceptions, for example. Now, if you have someone who's a realtor that has this additional income or a higher credit score, then you can get that exception waived so that person can get qualified for a slightly higher mortgage, for example. So, those are the small details that will be managed on a case-by-case basis. Because if you, for example, have cash savings, for example, RSPs and or RESPs in your account, that will make you a more favorable candidate if you had no savings. So there's a whole bunch of factors that kind of play to have the overall general approval on the file.
Let's talk about down payments for a moment.
Sure.
Because I think that's the big upfront cash you need to buy a home. So, could you clarify what are the options? What are the options that buyers have? 10% down, 20% down, less, more?
Well, it depends on the situation, but the minimum down payment will be 5% down of whatever the purchase price is, right? And then it kind of goes from there, right? Which is called the high ratio mortgages. High ratio mortgages are anything less than 20% down. And then if you get into a scenario where you're buying a house at 500,000 or more, the minimum down payment will be 5%. And then anything past 500,000, you have to come up with 10%, right? And so that's where you're getting deals where if you're buying a house for $600,000, you can then get qualified at 5% for the first 500,000. And then from the other 100,000, because it's 500 to 600,000, that will be 10%. And then you do a blended average of that to figure out what your minimum down payment is. Now, if you have a situation where somebody it doesn't qualify because their income is not strong enough to qualify, then that's when you move yourself up to do a 20% down scenario. And the reason why you would encourage someone to do the 20% down is because you can stretch the amortization out from 25 years to 30 years. And what that basically does is it shortens your monthly payment, which allows you to qualify for a larger mortgage. So that's why you see people sometimes looking to do 20% down, because they can get themselves into a bigger home and or get qualified for what they need to get qualified for.
Do interest rates change based on whether you're high ratio mortgage or
That's
not?
a good question. So counterintuitively, if you actually end up putting 15% down, you might get a better rate than if you did 20% down. And a lot of people, that's one of the big things that people don't understand. If you put down 10% down, you could potentially get, as of right now in this market, a rate of anywhere from 2.59 to, let's say, 2.79. Whereas if you're doing 20% down, you're getting 2.79 to 2.99, just as an example.
Wow.
And the reason why you'll be able to get a lower rate with less than 20% down is because you have to pay what is called the CMHC insurance, right? Default insurance, right? So that basically, in the case of the clients defaulting on the mortgage, then the insurer will then cover the cost of that mortgage, so the bank is not at a loss.
Yeah.
So from the bank's point of view, they're in a better situation at 5%, 10% down than 20% down. So therefore, they are wanting to encourage more of those type of files. So there's less risk for them. So that's why they'll be able to provide a lower rate for those situations, opposed to the 20% down files.
Just to clarify that on one moment, so a first-time buyer, 5% down, buys a place that's $420,000.
Correct.
So let's just say they have a $400,000 mortgage. They have a high ratio mortgage is it CMHC, Genworth Financial?
Correct. CMHC, Genworth, or Canadian Guarantees, one of the three.
If I remember it correctly, it's around 3.1, 3.2% premium?
It's a sliding scale, but it starts off at that, yeah.
So it's sliding scale, complicated math, but if you get a $400,000 mortgage and you're putting 5% down, you're tacking on an extra, at 3-ish%, tacking on an extra $12,000 of mortgage.
It's added into the mortgage, correct, and amortized over the life of the mortgage.
Over the life of the mortgage.
Yeah.
$12,000 in this Vancouver real estate market can easily be gained in a hot market. So, it is discouraging, but at the end of the day, if you are thinking long-term on the hold, it's a small price to pay to get a higher loan. Now, when you crack like a lot of 2 bedrooms in the burbs are, say, $600,000. And if you're trying to get the minimum down payment, assuming your income's good, are you suggesting that the first 500,000 of that 600 could be at 5% down?
Correct.
And then the remaining 100,000 would be at 10% down?
Correct.
Okay.
Yeah.
Okay. So that's blended. So that would be roughly a 6% down.
Yeah, well, 7.5%.
Okay.
Approximately, yeah.
Okay, cool. Okay. Is there any programs or incentives or things that we should know from a down payment side?
If you're a first-time home buyer, you're looking to get in the market, there's Homebuyers, first-time home buyers plan. They recently increased what you can pull out of your RSPs and TFSAs up to $35,000. So if you have money saved up into your RSPs, for example, you can pull out up to $35,000 out of your RSP. You have 15 years to repay that. The first 2 years of that, there's no interest. They will not penalize you for that. and then you have to repay 1/15 of it every year for the next 15 years. So you can use that money towards your down payment of your home for as a first-time home buyer. The government also came out with the first-time home buyers incentive program, where they're doing a situation where they're matching whatever your deposit is up to 5 or 10% down, depending on the scenario. And the difference between that and the first-time home buyers program is they're going to be giving you the down payment or matching your down payment, and you don't have to repay those funds. And when you sell your house, then that's when they'll recoup the money that they lent you, right? Mm-hmm. So that you're wondering, well, what's the use of that program? It is helpful for, the target audience or people that they want to help, which is first-time home buyers, because it allows them to have a lower monthly payment without added interest costs.
It could also help them get to 20% to be able to extend the mortgage to 30 years. Right?
No, because it's only for situations where it's less than 20% down.
It can't get you to 20%?
No, it's just for situations for less than 20% down. So high ratio files only.
Has that program come into effect?
The program has come into effect now, and the criteria is a very, specific criteria, such as you can't get more than 4 times your income in size of a mortgage, right? Any households making $120,000 or less, you have to make $120,000 or less to qualify for the program, right? And then the money has to be paid within 25 years or when the house is sold.
Did we figure out, is it the money that has to be paid back, or is it the percentage that they give you?
So the percentages that they give you. Right. So for example, actually I have some scenarios here so I can kind of...
Did you know that? So if they give you 5% of a $400,000 condo, whatever, and in 20 years you sell that condo and it's worth $650,000 or $800,000, you have to give them back 5% of whatever the sale price was.
Yeah. So I'll give you an example. So Bob wants to buy a new home for $400,000 and he has saved 5%, which is $20,000. Under the first time home buyers incentive program, Bob can receive $40,000 in the shared equity program, right? This will then help lower the monthly mortgage payment for approximately $200 to $230, which will then save him $2,740 for the year and every subsequent year from that point on.
Right.
When that house is sold, what will happen is whatever the house is sold for, the government will then collect their 10% back. In that case, if that house sold for $420,000, then the government will collect $42,000 because 10% of $420 is $42,000. When this program when he first got the money, the government gave him $40,000. Now the government will get their $40,000 plus an extra $2,000 because that represents 10% increase in equity for them.
Right.
So you're wondering, well, that's my money because, they're taking some of my net sale proceeds. But you have to remember, the government will then participate in the upside of the house sale, and they'll also participate in the downside of the house sale. So if there's a loss, the government will then take their 10% of the net loss. So
I would have loved to be in the room when the government was brainstorming ideas on how to stimulate home buyers. I mean, I get the intent. When you do, I've heard you chat about this before, Denny, and it's weird. Yes. There's scenarios where it would make sense to do it. Having government become investors seems weird to me. I feel like there's a simpler way to achieve the same outcome by loosening maybe stress tests or whatever that is. But at the end of the day, this is now effective, and I wasn't aware that it is effective. So it exists. So there's a time and a place for it. But as long as the buyer understands, they have a co-investor as the government.
I guess. So once again, I just want to highlight who this is. It's basically, it's a very niche product, right?
Yeah.
Because technically, if you do the math, it actually potentially can limit what they can mortgage that they can get because it's 4 times their income, right? And if you were to do the math on it, they might actually qualify for a larger mortgage than what this scenario does because it limits to the mortgage size to 4 times their income. But like I said, it's for somebody who has a little bit of savings and it allows them to have a lower mortgage, right? Which will then translate into lower monthly payments, right? And if they were also concerned about their savings and, where they can do with their available cash, they can kind of keep some money put aside, do this scenario where the government then basically helps with them with a larger down payment, and they can keep their money aside for miscellaneous expenses or whatever they want to do. So it's a very, very niche market, but it also helps stimulate the economy in terms of like a buzz about the market and people's optimism, because a lot of real estate is also about future and hope and giving people options to explore.
Yeah.
I find I just want to kind of simplify the math a little bit. And, so I guess just kind of, let's talk about how much a mortgage costs you. So let's go the investor angle here for a moment. If you're buying an investment property, is there a minimum down payment if it's strictly rental?
The short answer is, if you're buying an investment property, be prepared to put down 20% down.
20% down. Okay.
Yes. Because technically you could have your primary home and do, let's say, 10% down, and then convert that home into a rental and then buy a new primary home, for example.
Yeah.
But because of the way the CMHC guidelines work, your income has to qualify to run both homes. And because you have a smaller amortization, 25 years, you probably won't qualify. So the short answer is, if you're trying to buy a rental property, 20% down.
Let's go over some typical rental properties just to give a scenario. Right now I've seen some options for newer buildings, 1 bedrooms, close to the SkyTrain, newest suburb market, Tri-Cities, around $425,000. So, you're putting 25% down on $425,000. You have a $340,000 mortgage. I believe you gave us some numbers, and it seems like the range of cost of mortgage in terms of cash going out is about $400 to $500 per $100,000 mortgage.
Correct. Yeah.
Right, and it seems to be that there's options around the lower of that, so like $425. So if we went with $425,000 per $100,000 mortgage, is that okay?
Yeah.
To use that as an assumption.
Sure.
So $425 times $340,000 mortgage gives you $1,445 monthly payment for mortgage.
Yeah.
1 bedroom condo might have let's call it a $250 strata fee, and then maybe we add $150 for property taxes on top.
Sure.
Maybe there's another $100 for contingency. So let's call it $1,450 plus $250. That works out to $1,700 plus
another about $200.
Let's call it $200. So that's about $1,900. Maybe it's $1,950 cash going out a month if you're buying a 1 bedroom on a SkyTrain line for around $425. Right now, it depends on the building, but those are renting for around $1,700 to $1,800 a month.
I had a friend that has a 700 square foot place in Coquitlam right by the mall that was getting $2,200 rental.
Yeah. So some cases have been better.
Yeah.
Better. Well, let's say you're getting $1,800 and it's costing you $1,950. So, it's not quite a break even. We're close to it. Maybe it's a $100 gap or $150 gap.
Yeah.
But at the end of that 5 years, you're paying down that mortgage as well. So
absolutely. In that scenario, what happens is you're paying down the mortgage, right? So then you're going to have equity in the property. And then you're also looking for appreciation in the actual home as well, too, right? So like as if you're, in this Vancouver real estate market in the last 3 years, you were seeing home prices appreciating. How much were you guys seeing year over year?
Oh my gosh, 2016, 17 was 30 to 40%.
So that which is fantastic. That's not a typical scenario, right? But ideally, the whole idea is if you buy and hold it, you see a appreciation in the actual property. Plus, you also then have the mortgage being paid down. So you're creating equity there, right? And then the whole idea is if you hold this property for 5 or 10 years, what you look to do is you look to refinance, especially when you have those great years when the property really appreciates in value. You do a refinance, you take that equity out, and then you repeat and you do the same scenario. You buy another piece of property, for example, and you buy and hold. And the property starts cash flowing because the cash flowing starts to get better because over time, rents increase naturally and whatnot. And then your mortgage amount stays the same or goes down. And then you'll be able to get more cash flow coming in for that property. Plus, you can spin out the equity out of the refinance to use to buy another property and then do the same process again. So over a 10-year period, you can then slowly build your investment portfolio.
I think it's important to mention on that specific example, James gave was you're $150 roughly negative cash flow a month. But when you look at what you're paying into your mortgage was $1,450.
Yeah, $1,450.
So let's say $700 to $750 per month is going to paying down your mortgage. So when you look at it as a net formula, you're actually net positive $550 roughly.
Yeah, using that math, cash flow wise, you might be out, call it $1,800 in a year for a 1-bedroom condo rental, cash flow wise, but accounting wise, you might be profiting $6,000 a year.
Yeah.
And over a 5-year period, you might pay down your mortgage, call it, I don't know, $45,000. And so you started with, well, let's just use $40,000. So you start with a $340,000 mortgage on a $425,000 place. You leave 5 years of rental, it goes down to $400,000, and that $425,000 place goes up $50,000 in value over 5 years, which is pretty modest. But let's call it $475,000. So you've gained, if you've paid it down $40,000 and you've increased your value $50,000, you've gained $90,000 by being out $1,800 a year. So that's a pretty typical scenario. And does that make sense, Shaun?
It definitely makes sense. I also just wanted to kind of highlight as well too is this is also, when you buy rental properties or investment properties, it's forced savings, because when you're at forced savings for a tangible asset that you can see, whereas if people were to take their money and spend it and put it into, let's say, RSPs or TFSAs or whatnot, is the only thing they can do with that money is just put into investments. But with this is you can then use it to buy investment property, which you can then turn around and be able to get a mortgage on and leverage that property. So that's what the beautiful thing with buying an investment property is it's forced savings, because you're forced to use your available cash and put it into an investment property, which will then be able to allow you to turn around and leverage that property to then buy more property, right? So that's kind of why I really encourage people to consider that, because that money would be going out of their family income somewhere else, right?
Yeah.
So it's forced savings, which actually is good savings, right?
Yeah.
So basically, I think $1 million house is a pretty common number. So doing the math on what it would take to own $1 million home, in terms of whether it's a down payment scenario and income scenario, what you typically find to get to that $1 million house, and then also if that $1 million house had a basement suite, what that would look like.
Okay.
And then maybe I think there might get some value out of just a brief talk about the stress test, whether it's important or not.
Are you coming from the example of this being a full rental property, up and down?
No, I
think
a typical scenario is someone that's selling a condo, buying their first house.
Okay.
So how much equity and household income would they need?
Okay.
And then another scenario might be if that house had a basement suite.
$1 million house, Shaun.
Okay.
We're seeing a lot of clients who are making that jump, especially because single family home prices have come down a little bit in the last year and a half. A lot of young couples making that jump from their condo to the house.
Totally.
What does that scenario look like on the financing side in terms of what type of income do you need? What does your down payment look like, et cetera?
Well, so for starters, when it comes to $1 million homes, you're going to need 20% down.
Across the board, the scale doesn't work anymore.
Because there's a benchmark where anything below $1 million, you can do 5% down, 10%, 15% down. But once you get to $1 million and above, you'll have to do 20% down.
Yeah.
So that's the first step, right? I took some notes here. And what you see a typical scenario is, for example, someone living in a townhouse. They have the townhouse is worth $750,000. They have their 20% down in the townhouse, or they have $150,000 in equity, for example, and they have a $600,000 mortgage. So they're short of getting into a home, right? But what they'll do is they'll sell, take that equity out, maybe combine it with some savings they might have, get some money gifted from their parents, get themselves into that $1 million home. The difference in payments when you're paying a house for a townhouse, for $750,000 townhouse, your payments on a 30-year amortization are $2,520.
Okay.
Whereas if you get yourselves into a $1.1 million home, for example, 20% down, getting yourself into a mortgage of $880,000, your payments are $3,670. So that's a difference of $1,100 from a townhouse to a house.
Yeah.
what I want to highlight is the fact is that if you had a townhouse situation, right, where it was a $750,000 condo or townhouse, and you have equity in it of $150,000, so a $600,000 mortgage, and then you sell and you buy a house over $1 million, you get a little bit of additional funds to get yourself 20% down. The difference in payments is $1,150. And what I want to highlight is when you were paying for a townhouse or a condo, you were paying for strata fees, which is $250, $300, right? Whereas if you get yourself into a mortgage helper home situation, you'll be able to get renters in the basement from anywhere from $1,000 to $1,500 in the basement. So then all of a sudden now you're getting a house and you're getting the same cash flow or cash flow expense wise because they're covering that difference in higher mortgage payment. And you're going to likely see, you guys are the experts, you'll likely see a higher appreciation and value of a home versus a townhouse. I don't know if you guys will agree with that.
In the last 12 months, no, but long term, most likely.
I have lots of thought on that one. From a supply and demand perspective, houses with their own lot should go up considerably more than strata. It's just over the last 2-3 years, it hasn't been the case. So the question is, well, we have this affordability sort of wave that, determines price point a bit. This gap between detached and strata, it might show its colors 5 years from now. It might show its colors 50 years from now. But eventually, that gap is going to spread. I just don't know how quick it's going to happen. Anyway, that's my 2 cents. That's my 2 cents.
So fair enough, right? We're in a little bit of a different dynamic right now, right? But what I'm seeing is if affordability gets really constrained and it's making it extremely hard for people to qualify, this is my own personal beliefs as we'll see the government tinker with amortization rules. They might stretch things back up to 30 years or 35 years, right? Or they might tinker with the stress tests, right? So if you land, they're not making any more land, right? And so, if you have the opportunity to get a freestanding home where you have no strata fees, for example, you have a little bit more flexibility, right? Because that will then eventually be back in demand, right? So, that's what I'm thinking for the long-term consumer. If they have the opportunity to move from a townhouse into a home now, a lot of those homes a year and a half ago, I was seeing them in the $1.5 million range. Now those homes are dropping to 1.1, right? People are able to negotiate now. So there's a big opportunity right now if you're looking to move up.
I think it's a great time to move up.
Yeah.
Particularly the gap between strata and detached is closed. So it's a great time to make that leap because
a lot of people who are on the fence, this is the time for them to do it, right? Because the rates are still very low for a 5-year fix. You're looking at 5-year fix at anywhere from 2.79 to 2.99, right? So that is historical low still.
Well, the important thing you mentioned, Shaun, is your cash flow situation can actually be better.
Absolutely.
In a single family home that's maybe a few $100,000 more than your larger condo townhouse because of no strata fees and because of potential rent income from your basement.
What I'm seeing a lot of people doing is if you are living in 700 square foot condo or a 1,200 square foot townhouse, what you're seeing now is you're seeing people actually buying a house and then living in the basement and renting the upstairs.
Yeah.
So a typical house is 3,000 square feet. Let's just say you're seeing a family living in the basement, 1,000 square feet, and they're renting up the upstairs to 2,000, and they're getting anywhere from $2,500 to $3,000 in rental income, and then they're living in the basement, and it's their primary home, so there's no capital gains, right? And meanwhile, they're getting more cash flow than anticipated, and therefore they're being able to increase their net worth, and then get themselves into a situation where they can pay extra money onto the mortgage, and then as their family situation improves or grows, that's when they move upstairs, and then they have paid a whole whack of cash onto the mortgage. So I'm seeing a lot of that situation as well.
I had this question come up a couple days ago, actually. If you're renting out part of your home, whether it be basement, suite, or upstairs, doesn't really matter. Is the entire home classified as your primary residence? When you go to sell that home, do you pay cap gains on 25% if you're renting out the basement?
That is a question for an accountant, Denny.
Seek a professional accountant.
Yeah. So, it's your primary home, right? If you're living there and you're getting rental income, I think the general rule is you have to declare all sources of income, right? Because that's what the taxman wants, right? But it's a gray area because it's your primary home where you're living, right? But I think your accountant professional will say you have to declare all sources of income, right? But I've seen these situations where because it's their primary home and these renters are not like formalized situations, they come and go, then you don't see it being declared. But like I said, that's more of a conversation for their accountant.
Yeah, we've had those accountant conversations before. Maybe you covered this, but a lot of people that are jumping into the $1 million house, might be carrying a $700,000 mortgage. Maybe it's a $600,000 mortgage. Did you talk about, what kind of household income do you need to get one of those big mortgages, like a $700,000 mortgage?
Well, so that's a good question. So a typical scenario is you need about $100,000 family income to get yourself into a $700,000 mortgage.
Okay.
Right? Now, keep in mind, there's exceptions, right? Because the ratios is based on your TDS, GDS guidelines, right? And so no more than 44% of your family income can go to mortgage debt and lines of credit debts and all those other things, right? But that's where we're talking about scenarios where you can get exception to get approval for the same mortgage, but let's say lesser income, because you can then factor in rental income, for example, right? Or for example, if you had a lease payment, that will then affect your TDS ratios, right? However, there's some lenders that I work with at the office that will not make you count your lease payment on your car, for example, if it's being paid by your business. So the same person that comes in that's making $100,000 that has a lease payment of $500, that will impact their ability to qualify for that $700,000 mortgage. But that same individual, because that's being paid, if they're self-employed, being paid from their business account, then we can remove that from the application and they can get qualified for even more, right? So, or if you have cash savings, for example, you're able to get exceptions to get qualified for a little bit more. So we give the clients a little bit of a range because we don't know what spectrum do they fit on, right? Also, too, those individuals who have a higher credit score have a little bit more leeway in terms of like pushing the envelope into getting qualified for a larger mortgage. So there's a whole bunch of things that go along with it because it's not just whatever your income is. So a typical conversation goes for a client is, what is your range of home that you're looking for? And then we work backwards to figure out which lender I can work with to get you approved, because gone are the days where this is my income, what can I qualify for? It's more as a broker, and that's why it's a beautiful thing to work with a broker, is because we have different lenders we work with that we can then provide these scenarios that suits our clients' needs. If you're a self-employed individual, I have access to lenders that will look at your bank statements and qualify you off of your deposits, for example, right? Which will then allow you to get qualified for a larger mortgage opposed to what you declare in your line 50 and your T1 generals. So we figure out what your scenario, what you're looking for is. We're looking for a $1.3 million home, and then we work backwards and we fit a product for you.
And I think it's kind of important to mention, because we get people confused by this. When you get pre-approved for a loan, that's a pre-approval. It's not a firm approval.
Correct. Yeah. It's very semantics, because a pre-approval is almost sometimes not even like worth the paper it's written on, because the lender will give you a range and a rate range. But once you figure out whatever property you're looking at, then that's when it really matters, because you have to be able to have a property the lender feels comfortable with, right? And then that way because if you get a property purchased and it could potentially generate $1,500 to $2,000 in rental income, the lender won't know that detail until you find the property and then you get a economic rent letter specifically based on that postal code or address, right? Because if you're getting a home in, let's say, Chilliwack, and you're having a basement suite, the rental income that property can generate is a lot different than the rental income from a property purchased in Burnaby per se, or Coquitlam, right? So those are the things that need to be factored in when you consider what you can get qualified for.
Yeah. Outside of the rental, just the appraisal process too. Like a bank sends an appraiser in to confirm that the property is worth what you're paying, but they also look at, I've run into scenarios where, I bought a home that was falling apart, tear down home, rat infested, just an ugly, ugly home. And they didn't give it a life cycle or what
economic
lifespan or whatever that is to get a conventional mortgage. So, if you get pre-approved for a certain amount, but you're buying an ugly, ugly house that's falling apart, it may not appraise well. And that may affect the term of your mortgage or the down payment of your mortgage. It might go from 20% down to 35 or 50, depending on how bad it is.
Or no approval at all,
or no approval
right?
At all.
That's a very good point. I've seen a person that they're wanting to get a very good deal on a home purchase, and then there was some issues in the basement. There was like some sort of water leakage in the basement. The appraiser did their walkthrough, and they noticed there was water in the basement. That basically affected what the lender's ability to do that deal, because the property was not be able to be marketable again to be sold, right?
Yeah.
So that's why it's important to work with the professional to figure out what your approval range is, and then put an offer in subject to, and that way we can look at it, get the PDS, for example. That's why the PDS is very important, and that's why the appraisal is important as well too. 9 times out of 10, the appraised value will come in whatever the purchase price is, especially when it's done on MLS with a realtor, because it's a third party that's coming to the table with this purchase price. Whereas if you had scenarios where you're going through a family private sale, that's when they tinker with the purchase prices, and that's where you have a little bit of more variance in the sale and the appraisal. So 9 times out of 10, the appraisal will be on spot, but you never want to be that one client where you're missing out. So that's why it's important to kind of have all these things lined up. And then when you get the official approval based on that property that you're looking at, then the clients can feel comfortable to remove subjects.
Yeah, and when we're the listing agent, 9 times out of 10, we're talking to that appraiser to tell them what to appraise it at. So like a lot of times we're opening the doors for these appraisers. And from a realtor perspective, it is important to have a conversation with the appraiser. We know the market oftentimes more than they do on a localized level. So if there's features about the home, or if it ran into a multiple offer situation, or if it's sold above list price or some sort of scenario, we want to make sure he knows the conditions of the market and give him guidance on why it's sold for that price. Just in case he misses something.
Absolutely. Yeah. So
or she,
I encourage, like many times I encourage in the case of the buying realtor, for example, to be able to provide, when I would upload the request for the appraisal, they ask for any supporting documents. So that's where we can then bring in, comps in the marketplace, for example, because the realtor, if they're selling a condo, for example, they might have access to future MLSs that are coming on sale or completed sales that the appraiser might not see because it hasn't basically hit the database. Right. So that's when they can share, in the next week, this house is just sold for this value. So which will then support a higher appraised value, right? And so those are the type of conversations that we welcome. And if there's any supporting documentation that the realtors have, we will gladly accept it and then include it when we submit the deals to the appraiser.
Yeah, that's a very good point. I think they use BC assessed registered sales, not MLS ones. And in a crazy market like 2016 or 2017, you could underprice a home at, $1 million and it would get half a dozen offers and sell for 1.2. But if that appraiser walks through the door and didn't know that story, they might appraise it around the list price, thinking that it's $1 million home, not a 1.2. And secondly, if there is a comp that just happened a month ago, 2 months ago, close by that justifies that price, we're mentioning it to that appraiser just so they don't miss it.
Absolutely.
Yeah. Denny,
let's wrap up. But do you want to just briefly explain? I know stress test has adjusted was it in the summer?
Yeah, it did slightly.
Do you want to just explain stress test and then?
So basically, the stress test is basically the government has mandated any deals 20% down or below or 20% above has to meet. The person who's getting qualified for the mortgage has to get qualified at this benchmark. That's not going to be the rate that the clients will be getting for the mortgage, but it is basically a benchmark which allows the customer to know that there's a cushion in the event that the mortgages prices or mortgage rates skyrocket to this benchmark rate. They can then service payments based on this amount. So in this case, the stress test before in the summer was 5.39. So on 20% down home, you had to pretend that the client was getting qualified at a rate of 5.39. That's not the rate that we're getting in the summertime because people were getting rates as low as 2.69, 2.89 on a 5-year fix. But when I was qualifying for someone,
almost 3% higher.
I had to pretend that rate was 5.69. And that's what you're seeing why it's a lot of people are it was very difficult for people to get qualified for mortgages because the benchmark was such a high amount. Recently, in the summer, the benchmark went from 5.39 to 5.19. So the stress test qualifying benchmark was slightly better, right? But what that basically meant is their purchasing power increased by about 1.7%, right? So which was on a $1 million mortgage, it was an extra, I think it was like $9,000 to $13,000 approximately, right? So it's not going to move the needle on a home price, but it did create a little bit of it's more of a consumer sentiment. It was just saying that, things are moving in a direction where they're realizing that they were able to lower the stress test, which was encouraging. It's all about momentum and hope. So that's part of the reason why I think they did it. And we'll see, because this stress test has got the results that they wanted, which was a cooling of the market. And where things were going to go in the future, we don't know as yet. But that's the rationale of why the stress test was done.
Mm-hmm. Well, let me get, for the closing thoughts, Shaun, I think it would be great to get your brain on the future.
Yeah.
So we have credit cycles, the credit cycle. So when we look at 2017 or 16, when the foreign tax came in, that eliminated the foreign buyers a lot. Then the stress test came in, what was it, 2017?
It came in in January 2018, was it? Or
20? Yeah, it might have been 2018.
Yeah.
And then rates went up a bit. So that's like they're tightening credit, and they increased rates and increased stress test. Now they've gone backwards. Rates seem to be a little bit lower. Stress test has moved down a touch. If you were to look in your crystal ball a year from now, maybe 2 years from now, do you think is lending getting looser?
I don't think lending's getting looser.
Okay.
I think the lending will be what it is for, I think, the next couple of years, and we'll see what's going to happen, especially what's happening with this federal election, right? Because a lot of, sentiment is the outlook for the people, right? There's a minority government. They're not going to be able to kind of make the kind of drastic changes that they will be making. So you'll see things kind of status quo. And a big thing is that the government is trying to be aware of or clamp down on this fraud, right? So you're seeing a lot of more documentation, right? A lot of the old days when people were getting qualified would just be like a job letter pay stub. Now it's like job letter pay stub verbal to the employer and 2 pay stubs and, additional layers of documentation. So you're going to see the process to get qualified for a mortgage be where it is, if not a little bit more documents, right? Which you're going to see the market, like I said, respond by prices kind of like being steady, in my belief, for the next year or so.
Right? It feels like it's at a good space, which means like if it stays around, if credit stays at this level, like the stress test where it is and rates where they are, prices should be relatively, modestly growing, I guess.
Price will be modestly growing, and also to consumer sentiment. As people get more comfortable with things, people find a way to adapt, right?
Yep.
You'll see people find ways, if they want a home ownership, it's not impossible. You'll see people buying homes with family, for example, and all of them living in a bigger home and sharing the expenses that way, right? And then looking at refinancing, down the road. Or you're seeing people moving from a townhouse or a condo into a house and living in the basement, right? And then once again, going from there, right? Or people taking advantage of the lenders that have special programs for people who are self-employed. The rate is a little bit higher and potentially there might be a fee, for example. But if you look at the higher rate for someone who's self-employed and the fee, that is actually lower than paying more money in taxes, right? Because they're going to be able to get into the home. The home is a primary home. That home has no capital gains, for example. They pay less money in taxes and they still walk away higher. So you're seeing people talk to their accountant, talk to their mortgage professionals like myself, give them strategies and show them the long-term picture. So my positivity on this market is there's a positivity there, right? As long as people analyze what's best for them, there is a path that we can help them go towards.
And Shaun, before we close, Shaun Francis, Bespoke Lending, how can people get a hold of you?
You can get a hold of me by calling my cell phone, 604-787-4492, or you can email me, Shaun, SHAUN, at Bespoke, BESPOKE, Lending, LENDING.
Yeah, you got it. Awesome. Close it up, Denny.
That's all we got.
Thanks, Shaun.
Guys.
Thank you.
Appreciate it. Thank you.